Hey guys, welcome to a special webinar with WCG Investments. And I'm here with my partners, Tim Woodbridge and Matthias Grunwald. And today we'll give you an inside look at a mobile home park we are under contract in Sumter, South Carolina. It's a 74 lot mobile home park. So we'll walk through why this deal caught our attention and why this could be an exciting opportunity for our investors. Right, so we'll dive right in. Tim, can you tell us why investing in mobile home parks is a good idea? And then right after that, you can jump into the backstory of this particular park in Sumter.
Yeah, thanks, Vinny. We've been involved in mobile home parks for the last 5.5 years. And the longer I am involved in them, the more bullish I get on mobile home parks. The need for affordable housing is ever increasing, and mobile home parks help to solve that issue. On top of that, I mean, you've got very sticky tenants. You've got people who are owning their homes. You're able to create really nicer communities. And, overall, we're able to give investors really great returns and great tax savings. So, the more we do it, the more we're seeing how this is the solution for the affordable housing crisis, while still, doubling investors' money in 5 years through cash flow, through appreciation. The mobile home parks are very, very stable, very recession resistant. That's, one of my favorite things. I don't like staying up at night worrying about people leaving and stuff like that. These are stable enough where it's with proper management, things are really low touch point, I guess you could say. One of the best parts, again, for investors is how much they save on taxes in year one. There's a ton of depreciation through cost segregation and bonus depreciation that we're able to give our investors. I mean, on our other Sumter property that we just closed, we're giving investors, I believe it's 70 to 80 cents on the dollar projected in year one savings for every dollar that they invest, and that's with 40% bonus depreciation. So even before the 100%, it's still really good. So yeah, these are great all around. This particular deal, so I said we closed another one in Sumter recently. This is from the same broker. And we've been working on this deal back and forth for a while. At least 6 months, if not more, maybe 9 months. And initially the deal, they wanted this one price, but it was only one park, and it didn't make sense. And, we made the offer, they didn't want to take it. And so we just kept following up with them, keeping that good, warm, good relationship and keeping the deal warm. And then, eventually they fixed up a lot of the issues with the deal, which was causing us to have to give lower offer price. All of our offers are based on our investor returns. So, they fixed it up. They got people in. They got it running really well. And even then, they still wanted that same price, and man, we just couldn't get to that price. So it was a lot of back and forth and a lot of, well, can you do this? Well, can you do this? And it's just like, well, no, like here's the analyzer, to the broker. Check this out and see, maybe we're missing something, but it just kept coming back to, well, I know you guys want this price, but when we give you this price, our investor returns go lower than we're comfortable with. So it was just waiting them out and continuing to make the offer, and eventually they were ready to sell to us.
So you're saying there's a lot of dancing going on.
I love it. I love
Love
it. Yeah, yeah. And it's the North Star being the investor returns really helps, because I'm not asking for a lower price because I want to give a lower price. I'm asking for it in order for us to serve our investors the way we need to. But yeah, it's a waiting game, sometimes, and it's part of the dance.
Yeah, no, thank you for that. So Matthias, Tim mentioned that we already own a park in Sumter, right? So why is Sumter? What's so appealing about Sumter?
There's a lot of good things happening for Sumter. So they have the Shaw Air Force Base in the area, which is by far the biggest employer. That one has about like a $2.1 billion economic impact a year. So a major employer, a major foothold for the Shaw Air Force Base there, or for the Air Force Base in general. So that's really strong. There's other manufacturers out there that are really big manufacturers and well established in the area too, like Continental Tire. Eaton is producing there, and I have a heavy manufacturing background, and I work with these guys, and I know how difficult it is to move a manufacturing facility. So that usually means they stay there for a long time, and they spend a lot of money on research where to manufacture from a supply chain perspective, and where to get good workers, and where there's growth. So that big companies like Eaton and Continental Tire are there. That's actually a really good sign for a strong market. Economic growth is there. Obviously, population growth is there. For the last 50 years, it's been growing. Sumter pretty strongly. I like the proximity to myself and also Tim. It's kind of like right in the middle between me and Tim. Tim is down in Charleston. I'm in Greenville, South Carolina, and Sumter's kind of like in the middle between the two of us. It's like a 2-hour drive for me, and probably a little bit less for Tim. So almost right in the middle between us. So that's pretty good. And again, we have a park there already. With Whispering Pines that's in the area, which we have a very good community manager. She does a fantastic job there managing that park. So this gives us more economy of scale, where we have maintenance managers, we have handymen that can work with us. We have people that can do signage. We have people that can do plumbing, electrical work, etc. So everything is there already. So all the network is there, the infrastructure is there. It's just going to be like plug and play, really. Just adding that to the existing family. That's what I really love about it.
Yeah, and by doing so, right, having boots on the ground, having experience, having knowledge of the market, we minimize risk, right? It really comes down to that. Right. So just a reminder, right, this is pre-walkthrough. So right now we're looking at the data, we're looking at what's being provided by the seller, we're underwriting, we're tweaking. Matthias, what do we know so far about utilities? And maybe you can talk into like right now, what is the business plan? What makes sense?
Yes. So like Tim mentioned, we've been working on that deal for a long time. We know a lot before we even get under contract. And when we get under contract, we start due diligence immediately. So we take everything apart. We know everything about the deal so far. When we do our walkthrough, we just want to verify a lot of details that we already discovered on paper. But there's so much to be said actually being there, feel it, smell it, and just just being there and talk to the tenants, talk to community managers if they have any there. And it goes a long way to be on site. But from a utilities perspective, everything is direct built on 2 out of the 3 parks for water and sewer. The other one is direct built water, but has a septic system, which is in line with our other park we already have there with septic systems. And we have many septic systems in our portfolio for our 16 communities. So we know how to manage them. We're not really afraid of them at all. So that works really well. So it's the majority is park-owned homes, which again many people shy away from, but we love them because they give us extra cash flow and we convert them into tenant-owned homes over time. And that's enables us to give better investor returns because we have the extra cash flow in order to double the investors' money in the 5-year time frame or earlier. So this is actually very strong on that front. So what else do we know about it? We know it's in a strong market, obviously, because Sumter is a good market. And the numbers itself, the cash flow is pretty high. So it's a cash flow heavy deal, which means that cash on cash returns are pretty strong. Which we verified on the financials already during due diligence. So we have a accounting veteran on the team. He does all the reconciliations between the bank statements, income statements, and I reconcile with my underwriting at the same time. And we already did that. That's already done. So we know all the numbers check out within a couple dollars. So it's really strongly reconciled already. So we know that financially checks out. And it's what we usually do before we go too deep into the deal and before due diligence is over, to make sure that all the potential deal breakers get the green check mark before we continue, because we don't want to put any earnest money that the GP team puts on the line at risk, and we don't want to proceed with a deal that also puts our investors' money at risk. So we take everything apart before we even get out of due diligence and before we even do the walkthrough. So I feel like we're stalking the deal for a very long time until we meet her, basically. So yeah, that's what we currently know about it.
That's awesome. And just want to clarify that it's a 3-part portfolio, and it totals to 74 lots. So what are we thinking right now, guys, in terms of the business plan, right? It sounds pretty straightforward. Tell the listeners about it.
Yeah, it's 74 lots, like you said. The majority is park owned, which is 86% of them are park owned, so 64. There's a few empty pads, but only 6 of them. So that's not that many. So business plan wise, it's extremely conservative. We think we can get at least 1 new home in year 1 and then 2 in each subsequent year, which is extremely doable. So in the other deals we did infill before, we could get 2 homes in 2 months. So we give ourselves 12 months for that in that market. And then with the park-owned homes, we slowly turning them to tenant-owned homes via renter-owned contracts and sell them off. Obviously, you cannot force people that already live in it to take a renter-owned contract. We're going to offer it to them, but we're not going to force them to. So that's why we are underwriting in such a way that we only have less than a handful converted per year, but which drops the expense ratio down bit by bit. That also compresses the cap rate because it becomes a more desirable deal for a refinance or any other capital event, like a sale later. And then right now it's heavily still on the market. I think the rents right now, if I look this up, is in the low 300s. Market is 475. So it goes to show, in that market, there's a lot of mom and pop operators. Like the other park that we bought, Whispering Pines, was the same way, where we had 225 lot rents and market is 475, and this one is right at 300. It should be 475. So we were heavily on the market. With the rent increases, the plan is to do in year 1 a $35 increase. We always go light in year 1, do the improvements first, show the community we make the improvements, and then we do them efficiently. And we also give the residents our ear and open our ears and with surveys and see what they want changed and what they want improved, which is very important to us. And then we make improvements happening over time. Of course, we're not gonna get all the items completed on the wish list that we get from the tenants. That's one of the reasons why we do the walkthrough, to identify more items that we might need to see. And then in the next couple of years, year 2 is a $50 increase, and then year 3, 4, and 5 is just $35 and $25. So really small increases, really, really small. But that catches us up to market, and we're still riding that wave with a strong market, even ever increasing. So, and that gets us to really strong returns already, and that's extremely conservative. Arguably, you can do higher rent increases if you want to be more aggressive. You can do more infill. And also to the audience, don't get us wrong, we're going to aim for much faster infill if we can. So if we can do all 6 in the year 1, we will. So the IRR is going to increase dramatically, but we conservatively underwrite those deals to stress test them right out of the gate. And if we still meet those metrics, then we know it's a good deal. That's how we do it.
So what I'm hearing is increasing rent slowly, infilling, but it's pretty much like a handful of homes that we're infilling in a 5-year period. Right, in the market that we are very familiar with. I mean, it sounds pretty good to me. Tim, so when we do our walkthroughs, what are we looking for? And what are some red flags that would make us say, you know what, this is a showstopper, right? Let's walk away.
Yeah. So the first thing that we're looking for is to make sure that what we were told in the OM and by the broker, it matches reality. So we're going to count the lots, we're going to count the homes, make sure what they told us was there. It happens a lot in mobile home parks, and it's not I don't want to place blame on anyone. It just like happens, you know. Sometimes they they say, hey, this one has 40 lots or like 50 lots and like 40 park owned homes, right? And then you go there and you count and there's only 30 and you're like, am I seeing this right? And then it's a continued discussion. And funny story is we dropped a contract recently because it was exactly that. It was 40. They said they had 40 after we went and did some on-site, just preliminary DD. We saw that there was only 30 and asked for more clarity. And they're like, oh, my bad. I didn't know. And, again, not blaming anyone. It totally happens, but it was something we had to walk away from. And so same thing, we'll be counting and making sure everything's adding up. And then other than that, we put eyes on the park, make sure, see how the roads look, see if we need to adjust any CapEx in the analyzer and pro forma, and see if there's any signs of any septic issues. We will be having a septic company go out and inspect a handful, usually about 10% of the septics, making sure that there's not going to be anything crazy in terms of needing to replace anything in the near future. And if there is, and it's okay, let's put that into the underwriting and account for that. So there's no surprises. And then, other than that, just, looking for, are there any trees that could be an issue? Are there any, electrical lines that could be an issue? There's nothing like being on site and seeing things and being like, okay, like I'm cementing this in my head and can see, and we can compare that with the business plan. How realistic is the business plan versus reality? That's what we're really looking for.
Absolutely. Can you talk to the inspections that we perform, kind of like the phase one environmental, that kind of thing?
Yeah. So, we do a phase one. We'll do a phase one on all 3 parks, making sure that we get a clean bill of health from like an environmental standpoint. There's no potential hazardous issues that could come up. And then, we'll also be getting like an Alta survey, making sure that, okay, what we think we own is what we own. And then other than that, like for our on-site due diligence, we'll be walking inside all of the park-owned homes to make sure, like, okay, again, is what we think what we're getting, and Matthias is great in that, whatever we find, he goes in and adds that into the analyzer. Okay, do we think that we're going to have to put more into the homes than we thought initially? Well, he goes and puts that into the analyzer. What does that look like? Do we need to raise more money to account for that? How does that affect the returns? And do we need to ask for a price reduction? I don't know. We'll see when we really get there and are able to more analyze what the actual reality of the deal is.
Yeah, something that's really important to point out is what Tim mentioned earlier. We start with the returns to the investors. That's our starting point, and then we negotiate from that, right? But we want at least 2x investors' money, and that's the starting point. Then everything that we negotiate, we go back and forth, we do the little dance, right? Making sure that we get that 2x minimum to our investors. So since we're talking about numbers and returns, Matthias, what are the projected returns looking like for this particular deal right now? Of course, everything could change right after the walkthrough, but right now, what is it looking like?
Yeah, it's a 2x, almost 2.1x equity multiple, which means if you put $100,000 in, you get up to 210 back over the 5-year whole period. IRR is like 17.8% right now. That's the nominal, right? So there might be a range, let's say 16 to 19%, and that's all with like the very conservative infill and very conservative rent increases. So they can easily be increased. So I usually run like a best case and a worst case scenario. So this is kind of like on the middle to lower end. So this deal could easily be like a 2.5x equity multiple range with a 2.5 equity multiple and close to 20% IRR returns if we get the inflow done quicker and get the expense ratios lower faster by turning homes over rent to own. And that's one of my favorite questions I ask usually on the walkthrough is we walk through all the park-owned homes, which is a lot of work, but you discover so much. And then we talk to the tenants and just ask them about what problems they see with the unit and stuff like that. If there's any roof leaks or any other problems, and there's almost no other group of people that are more honest out there than a pissed off tenant. So they're gonna tell you that definitely what is wrong with the unit and what's wrong with the community and the managers. And then from there, we can also ask the question, hey, would you buy this trailer if you would offer this to you if you take over? And then you usually get a really strong, yes, of course I would love to be a homeowner. And sometimes they say, no, I just want to rent. But you get like a good feel on the current tenant base, how much we actually would take that over. And I take that information after every walkthrough and create my V2 underwriting, my version 2, based on what Tim said, like the CapEx, hey, we need more tree trimming than expected, or we need less. Or I think we can turn them over really a lot faster, those park-owned homes to tenant-owned homes, for a reason, because everybody was just so excited about the fact they can, buy this home over from us, if we give them the opportunity, and then we re-underwrite it. So almost always there's a significant difference in the underwriting from before and after the walkthrough in a positive way, because there's more clarity. There's only so much you can do on paper, and we do as much as we can. But once you're there, then you get that's like the last 10%, and then okay. Then we in our team, then we get the confidence, like, okay, we can do this exactly this way, and then we know we can hit those returns very confidently.
That's awesome. As an investor, right? I'm trying to invest my money. My question to you would be, how are you stress testing the financials for this deal?
I usually put in like a lot of like 7.5%, 10% of bad debt in year one. Bad debt meaning like delinquencies. If we take over, people try to test limits with new owners, then we institute new rules probably the previous owner didn't have, and people stop paying, they don't pay their fines, there might be more evictions. It always happens. There's always like this little dip in the beginning, then it goes uphill. Always stress test it that way and push a lot of bad debt into the financials, which is extremely conservative as well. Again, the way it's already underwritten with the rent increases, you can definitely go a lot higher than $35 in year one. And people are not stupid. They know they get a stinking deal right now by paying $300 lot rent. The market's $475. I just have to go online and see that pay $175, $200 more. And there's always going to be somebody that's not going to like it. That's normal. But we always also have the communication very clear and transparent with the tenants about why we have to increase rents, obviously. So that's one way to stress test it. Also on the pro forma side, if we go into the pro forma, you can see that we have very slight decreases on the expense ratios, which arguably you can have a lot higher decreases over time, which means that we increase the NOI much faster than expected. So that's kind of a backstop as well. And what else do we put in here is that on the financials, I always make sure that we have the same amount or more expense than the previous owner in year one, just because we have to get familiar with the deal, familiar with the community, and don't try to be the hero in year one. Like, it's just for easy numbers. Let's say they have $200,000 expenses. I'm not going to say, oh, we have 150 in year one. You probably won't. So we have a little bit higher in year one, and then we're decreasing over time, like this little dip I was talking about. That's how I stress tested. Almost always, like from the deals that we've done so far, we actually always lower a little bit than the previous owner, and then increasing the performance or decreasing the expenses from there. But to stress test the deal, I always have a backstop of the current expenses from what the seller had before in their performance, unless there's something really obvious that stands out in the financials that we obviously won't have. Like, there's some expense that maybe just really seller related. They're running their automobile travel expenses for the P&L, or something else that's weird or whatever. They had obviously CapEx in it in the financials and impact the NOI, which shouldn't be an NOI thing because they didn't run the financials properly. So there's outliers of that. There's an exception to the rule, but those are the big things I use for backstopping or like stress testing the deal.
Yeah, I love it. Tim, how are we mitigating risk?
I mean, like Matthias just said, we stress test the deal, we make sure that it works. And then, like I was saying earlier, mobile home parks are very recession resistant. So, I mean, it's the most affordable place to live in town. You don't have a lot of people leaving, and there's not a high turnover really with tenant-owned homes, which is a big portion of this. One of the business plan items is to convert people to more long-term rent-to-own, whatever term, longer-term contracts so they can purchase the homes. And when that happens, like tenant-owned home, like tenants will stay 5, 10, 15 years, 20 years, I think, in our Oklahoma City deal. So they're really they're really great for having really sticky tenants, which makes it a much safer investment. You see a lot of the apartment deals right now, and they're having difficulty keeping tenants, and there's all sorts of weirdness in the market right now. So like, who knows what's going to happen, but I have noticed from some friends who are more in apartments that they're having a more difficult time attracting tenants, and they're having to do all these concessions and stuff like this. With our parks, again, we're the most affordable place in town, so they're not going to find anything better or cheaper, or more affordable. So people will stay around for a long time, realizing that this is the best that they can. Not the best that they can do. That sounds weird, but it's like it is the solid place for them to live and to stick around. So like, again, I love mobile home parks because how sticky tenants are. And as long as you treat your tenants with respect, and make it a nicer place to live, you've got people who will stick around for years.
Awesome. So there you have it, folks. This is our pre-walkthrough webinar. So we just want to give you an insight of what's taking place. We have a deal, we underwrote it, everything is looking really good. We're hitting our marks in terms of what we look for returns to our investors. So now we will be traveling. Actually, Matthias and Tim will be traveling to the park within the next week or so. So we'll keep you posted, but we just want to bring you along for the ride, right? We want you to be a part of this journey. So you have insight into what takes place at the beginning, in the middle, and at the end, right? When we're getting ready to close, or even after we close, we want you to be a part of the journey. And just so you guys know, this will be a 506c offering for accredited investors only. Once we get to that point, right now we're still in our due diligence phase. Tim and Matthias, one last question for you. Think about one thing that a potential investor should really pay attention through this process with this particular deal.
Attention to detail. And we've been working on this deal not just yesterday. We've been working on it for over half a year. There's a lot of hard work paying off for the entire team right now. A lot of due diligence has been done with our DD team. Underwriting, I'm not sure how many versions of underwriting I have already in updates. Every time we discover something, I change things. So that I think there's a lot of thorough work being done. The attention to detail. I don't think many do that as the way we do it. We take everything apart and then some. So that's what I would say about that.
Tim?
I'd say make sure to talk with your CPA so you can take full advantage of all the depreciation that this will throw off. It's so much depreciation. It's crazy. And it'd be a shame to not take advantage of it.
Good stuff. This is exciting. I'm really looking forward to the walkthrough to see what we find, and hopefully everything checks out. And soon we'll be recording a webinar, celebrating, how we close this deal and getting ready to execute the business plan. This is awesome, guys. So yeah, thank you guys for your time. This has been awesome, and we'll keep you posted. We'll be sharing some reels on Facebook and LinkedIn, Instagram, on how the walkthrough goes. But yeah, I guess we'll talk next time. Have a good one.
Cheers, guys. Thank you.